The United States and Canada have long shared one of the world's most integrated trade relationships. For decades, goods, services, and raw materials flowed freely between the two nations, supporting jobs and industries on both sides of the border. However, this balance was disrupted when the U.S. government imposed a sweeping set of tariffs on Canadian and Mexican goods on February 1, 2025. While these measures were framed as a response to border security and drug trafficking concerns, their real impact was economic. The U.S. was looking to put pressure on Canada's economy, forcing the country into submission through aggressive trade restrictions. The tariffs were wide-ranging, affecting most Canadian exports except for oil and energy, which faced lower rates. The strategy seemed clear: apply economic pressure, force Canada to concede, and reinforce American dominance in the trade relationship. The assumption in Washington was that Canada would absorb the blow and eventually negotiate under U.S. terms. However, this assumption was flawed. Instead of backing down, Canada responded with an economic counterattack that not only hurt American industries but also challenged the very idea that the U.S. could dictate trade terms without consequences. Just days after the U.S. tariffs were announced, Canada unveiled a powerful response: a $155 billion tariff package targeting American exports. Unlike the broad and unfocused U.S. measures, Canada's response was calculated and strategic. The first phase, valued at $30 billion, was implemented immediately and focused on key American industries with high political and economic importance. The second phase, worth an additional $125 billion, was scheduled to follow soon after, ensuring that the pressure would not be short-lived. This aggressive move by Canada marked a turning point. The countermeasures targeted sectors that were not just economically vital to the U.S. but also politically significant to the current administration. The Canadian government was not just reacting, it was ensuring that the impact was felt where it would hurt the most. By focusing on industries with strong lobbying power and political influence, Canada aimed to turn American businesses and workers against their own government's trade policies. Despite its strong response, Canada could not completely avoid the economic damage caused by the U.S. tariffs. The restrictions led to an estimated $2.1 billion loss for the Canadian economy, affecting various industries that rely on cross-border supply chains. The automotive sector was among the hardest hit, with manufacturers struggling to deal with increased costs and logistical disruptions. Agriculture, another key industry, also faced major setbacks, particularly in the export of grains, dairy, and meat products. Additionally, Canada's technology sector, which depends on U.S. partnerships and investments, experienced financial strain as businesses adjusted to the new trade environment. While these losses were significant, it soon became clear that the U.S. was not escaping the consequences either. Canada's countermeasures began to take a serious toll on American industries, demonstrating that economic warfare is never a one-sided battle. The U.S. had underestimated the impact of retaliatory tariffs and was now experiencing the full force of Canada's economic pushback. The effects were felt almost immediately in sectors that relied heavily on Canadian trade. American manufacturers that depended on Canadian raw materials and supply chains were suddenly faced with rising costs and production delays. Agriculture, one of the most politically sensitive industries, was also feeling the heat. Canadian tariffs on American agricultural products, including beef, pork, and grains, made it harder for U.S. farmers to sell their goods across the border. This led to surplus products in the domestic market, driving down prices and cutting into farmers' profits. Meanwhile, the American automotive sector, already under pressure from global supply chain disruptions, was further impacted by Canada's targeted tariffs on U.S.-made vehicles and auto parts. These tariffs made American cars more expensive for Canadian consumers, reducing demand and putting additional strain on U.S. auto manufacturers. Companies that had relied on a steady flow of exports to Canada now faced declining sales and increasing uncertainty about their future. The economic strain caused by these tariffs was not just limited to businesses. Consumers in both countries began to see rising prices as companies passed on the higher costs to customers. Grocery store prices increased due to the added costs of importing food products. The price of household appliances, clothing, and electronics also saw an upward trend as tariffs affected consumer goods moving across the border. In the U.S., frustration was growing as businesses and workers started to realize the true cost of the trade war. The Canadian government made it clear that its countermeasures were not just about economic retaliation, they were about defending national sovereignty. Canadian leaders framed their response as a necessary action to protect jobs, industries, and long-term economic stability. They emphasized that Canada was not willing to be bullied into submission by a trade partner acting unilaterally. Prime Minister Justin Trudeau publicly stated that Canada was willing to negotiate a resolution but would not do so under threats or economic coercion. His message was clear: if the US wanted to impose unfair trade restrictions, Canada would respond in kind. This approach not only rallied domestic support but also reinforced the idea that Canada was prepared to stand its ground in the face of economic aggression. As tensions escalated, questions began to emerge about the broader implications of this trade war. Was the US underestimating Canada's ability to fight back? Could this dispute lead to long-term damage to the North American trade relationship? And perhaps most critically, was the US risking its own economic stability in an attempt to assert dominance over a key ally? The economic backlash was only beginning, and the consequences were becoming increasingly difficult for the US to ignore. While Washington had initiated the trade war with the expectation of gaining leverage, it was quickly becoming clear that the strategy was backfiring. With supply chains disrupted, industries struggling, and political pressure mounting, the US found itself facing a growing crisis of its own making. This trade dispute was no longer just about tariffs, it was about economic survival, political consequences, and the shifting balance of power between two of the world's closest trade partners. As Canada continued to escalate its response, the impact on the American economy was only going to grow. The question now was not whether the US would feel the consequences, but how severe those consequences would be. What had started as a calculated move by the US to pressure Canada into submission had instead ignited a trade conflict spiraling out of control. The economic losses, industry disruptions, and growing political fallout suggested that this was not going to be an easy battle for either side. With tensions rising and no immediate resolution in sight, the future of US-Canada trade relations was more uncertain than ever. Canada's $155 billion retaliation against the US has sent shockwaves through the global economy, triggering a domino effect that threatens to cripple American industries and send unemployment rates soaring. The economic standoff, born out of ongoing trade disputes and policy clashes, has escalated into a full-scale crisis with far-reaching consequences for both nations. While tensions between the two countries have flared up in the past, this unprecedented move by Canada represents a dramatic shift in the balance of power, forcing the US to confront the vulnerabilities within its economic framework. At the heart of this crisis lies a combination of tariffs, trade restrictions, and financial penalties that have disrupted key industries, from manufacturing to agriculture and energy. With Canada being one of the United States' largest trading partners, this retaliation is not just symbolic, it is a direct hit to the American economy. The ripple effect is already being felt as major corporations, especially in sectors reliant on cross-border trade, struggle to navigate the new economic landscape. Supply chains have been thrown into disarray, causing production slowdowns, increased costs, and widespread layoffs. The labor market, which was already facing uncertainties due to inflation and shifting global dynamics, is now on the brink of collapse as businesses cut jobs to offset mounting losses. American workers are among the hardest hit by this economic retaliation. Manufacturing plants that depend on Canadian imports for raw materials are shutting down operations, leaving thousands unemployed. In the agricultural sector, US farmers are grappling with plummeting export opportunities as Canada imposes restrictions on American produce. This is particularly devastating for industries like dairy, wheat, and livestock, which have long relied on Canada as a key buyer. The energy sector is also facing severe repercussions, with Canadian policies limiting access to critical resources that fuel American industries. As a result, businesses are either downsizing or shutting their doors entirely, leading to an alarming rise in unemployment figures. The stock market has not been immune to the chaos. Investors are pulling out of US markets at an accelerated rate, fearing further economic instability. Major corporations are witnessing plummeting stock values, and financial institutions are warning of potential long-term damage to the economy. The uncertainty surrounding the situation has also weakened consumer confidence, leading to reduced spending, further exacerbating the economic downturn. With inflation still lingering and the Federal Reserve attempting to stabilize the economy, the timing of this crisis could not be worse for the US. The political implications of this economic conflict are just as significant as the financial ones. The Biden administration is under immense pressure to find a resolution, but negotiations with Canada remain tense. Many lawmakers are calling for swift action to de-escalate the situation, but others argue that standing firm against Canada's retaliation is necessary to protect American interests. Meanwhile, Canada's government has shown no signs of backing down, emphasizing that its actions are a direct response to what it perceives as unfair US trade policies. The longer this standoff continues, the greater the risk of long-term damage to diplomatic relations between the two allies. For American workers, businesses, and consumers, the question now is, what's next? If the situation remains unresolved, the economic downturn could deepen, leading to further job losses, a prolonged recession, and even greater instability in global markets. Some experts warn that unless both nations reach a compromise soon, the economic fallout could extend beyond North America, affecting international trade and financial markets worldwide. While efforts to negotiate a resolution are underway, the outcome remains uncertain. The stakes have never been higher, and the decisions made in the coming weeks will determine the future of US-Canada economic relations for years to come. Canada's $155 billion retaliation against the US has triggered an economic crisis that is sending shockwaves through industries, financial markets, and the labor force. The United States, which has long relied on Canada as a key trading partner, is now facing one of the most significant economic disruptions in recent history. What began as a trade dispute has escalated into a full-scale economic confrontation, with Canada taking unprecedented action to counter American policies that it perceives as harmful. The consequences are already unfolding, with industries struggling to cope, job losses piling up, and financial markets reacting to the uncertainty. The looming question remains: how will the US economy recover from this blow, and what are the long-term implications for North America's economic stability? At the core of this crisis is the fact that Canada and the US have deeply intertwined economies. Trade between the two nations amounts to hundreds of billions of dollars annually, with goods and services flowing seamlessly across the shared border. However, recent policy disputes have strained this economic relationship, leading Canada to impose strict financial measures that have effectively crippled key American industries. Tariffs, trade barriers, and investment restrictions have severely disrupted supply chains, forcing companies to scramble for alternatives and absorb rising costs. As businesses struggle to adapt, the American workforce is feeling the brunt of the impact. One of the hardest-hit sectors is manufacturing. Many US factories rely on Canadian raw materials, including aluminum, steel, and lumber, to produce goods ranging from automobiles to construction materials. With Canada cutting off or heavily taxing these exports, American manufacturers are facing severe shortages, causing production delays and increased costs. In response, many companies have been forced to lay off workers or shut down operations entirely. The effects are rippling through communities that depend on manufacturing jobs, leading to economic distress in regions that were already vulnerable to industrial decline. The agricultural sector has also been severely affected. Canada has long been a top buyer of US agricultural products, including wheat, dairy, beef, and soybeans. However, with the new trade restrictions in place, American farmers are struggling to sell their goods across the border. The result has been an oversupply of agricultural products in the US market, leading to plummeting prices and financial struggles for farmers. Many have been left with no choice but to reduce production, lay off workers, or even shut down their farms altogether. This has not only hurt farmers but also the broader food supply chain, impacting distributors, retailers, and consumers. The energy sector, another cornerstone of US economic strength, has also been caught in the crossfire. Canada is a major supplier of oil and natural gas to the US, and any disruption in this trade relationship has profound consequences. With Canada imposing restrictions on energy exports, American refineries and energy companies are struggling to secure the resources they need to operate efficiently. This has led to rising energy costs, reduced industrial output, and increased pressure on American consumers, who are already dealing with inflation and economic uncertainty. Higher fuel and electricity prices have made it more expensive for businesses to operate, further contributing to job losses and economic instability. The financial markets have responded to this crisis with alarm. Investors are growing increasingly nervous about the long-term impact of Canada's retaliation, leading to stock market declines and capital flight. Major U.S. corporations that depend on cross-border trade have seen their stock values plummet, as uncertainty about the future weighs on investor confidence. Financial institutions are warning that if this economic standoff continues, it could trigger a prolonged recession, with lasting damage to both the American and Canadian economies. Beyond the immediate economic consequences, the political ramifications of this crisis are also significant. The Biden administration is under immense pressure to find a resolution, but negotiations with Canada have proven difficult. While some policymakers are pushing for aggressive countermeasures against Canada, others are urging diplomacy and compromise to avoid further escalation. The political divide within the U.S. government has made it challenging to reach a consensus on how to respond, prolonging the uncertainty and deepening the economic fallout. Canada, for its part, has shown no signs of backing down. Officials in Ottawa have made it clear that their actions are a direct response to what they see as unfair U.S. trade policies. They argue that Canada is merely defending its economic interests and ensuring that American policies do not disproportionately harm Canadian industries. This firm stance has made it difficult for both sides to reach an agreement, increasing the likelihood of a prolonged economic standoff. For American workers and businesses, the situation is growing increasingly dire. Layoffs are mounting, consumer confidence is dwindling, and the broader economy is beginning to feel the weight of the crisis. If the trade conflict is not resolved soon, the U.S. could face a deeper economic downturn, with long-term consequences that extend far beyond North America. Industries may permanently shift supply chains away from Canada, leading to lasting changes in trade dynamics. Small businesses, unable to withstand the prolonged economic pressure, may be forced to close their doors for good. The longer this crisis persists, the greater the risk of a full-scale economic collapse. Experts warn that unless both nations find common ground soon, the damage could extend beyond just the US and Canada, affecting global trade and financial markets. Other countries that rely on US-Canada trade may also face disruptions, further destabilizing the international economy. The world is watching closely as the two economic giants navigate this crisis, knowing that the outcome will have far-reaching implications. In the face of mounting economic uncertainty, American workers, businesses, and policymakers must prepare for what comes next. Whether through negotiations, policy adjustments, or economic interventions, a resolution must be found before the damage becomes irreversible. The future of the U.S. economy, and the livelihoods of millions, hangs in the balance.